Listen carefully, because if you own something like 500 ounces of silver, you are no longer just holding a passive asset. You are participating in a much larger shift that most people still do not fully understand. I am not talking about a minor price fluctuation or a short-term trade. I am talking about a structural change in how wealth is stored, protected, and ultimately repriced when the system itself begins to strain. Most investors believe they understand why they own silver. They think of it as insurance, a quiet hedge against inflation, something that sits in the background while the rest of the financial world continues operating as usual. But that assumption depends on one critical belief that the system remains stable enough for silver to stay in that passive role. And that belief is now being tested. The real question is not whether silver moves higher next week. The real question is what silver represents when the financial environment itself begins to shift. Because history has shown this again and again. Major turning points do not announce themselves clearly. They begin quietly, almost invisibly, while most people continue focusing on the same assets, the same narratives, and the same assumptions that worked in the past. Then something changes, and when it becomes obvious, it is already too late to position properly. Right now, silver is sitting in the middle of that kind of transition. For years, it was ignored. It moved sideways. It frustrated investors. Capital flowed elsewhere. Growth stocks, speculative sectors, easy money opportunities. That environment conditioned people to stop thinking about silver as strategically important. But markets do not care about comfort. They respond to pressure. And when pressure builds long enough, the system eventually adjusts, whether investors are ready or not. This is not speculation. This is structural. For a long time, silver pricing was dominated by financial instruments, futures markets, derivatives, algorithmic trading. On the surface, it looked like supply was abundant and easily available. But underneath that financial layer, the real world was telling a different story. Demand has been rising steadily, not because of hype, but because of necessity. Modern systems require silver. Energy infrastructure depends on it. Advanced electronics depend on it. Telecommunications, medical technology, data systems. As the global economy becomes more technologically integrated, silver's role expands quietly in the background. At the same time, supply has not kept pace. Mining output has struggled to grow meaningfully. New discoveries are limited. Costs continue rising. Political and environmental constraints slow expansion. This creates a condition that markets can ignore for a while, but not forever. Because when demand increases and supply remains constrained, pressure builds. And pressure does not disappear. It accumulates. Now listen carefully, because this is where most investors get it wrong. They expect major moves to look clean and obvious, a smooth trend, a clear confirmation. But that is not how real transitions happen. Real transitions are volatile. They are uncomfortable. They create confusion. Silver does not begin moving in a way that reassures investors. It begins moving in a way that tests them. Sharp rallies followed by pullbacks, conflicting narratives, analysts arguing over whether the move is real or artificial. But the noise is not the signal. The signal is the change in behavior, and silver's behavior is beginning to change. It is no longer acting purely like an industrial commodity. It is starting to reflect characteristics of a monetary asset again. And that distinction matters more than most people realize. Industrial commodities rise when growth accelerates. Monetary assets rise when confidence begins to weaken. And right now, confidence in parts of the financial system is quietly being questioned. Most investors are looking in the wrong place. They are watching stock markets. They are watching interest rate decisions. They are watching earnings reports. But beneath all of that, another signal is emerging: the bond market. For decades, bonds represented stability. Government debt was considered safe. It was the anchor of the system. Investors believed central banks could always intervene, always stabilize, always maintain order. But that assumption is being challenged. Years of low interest rates encouraged massive borrowing. Governments expanded deficits. Corporations relied on continuous refinancing. Debt accumulated everywhere because it seemed manageable. But debt behaves very differently when interest rates rise. What once looked stable begins to look fragile. This is why volatility in bond markets is increasing in ways that experienced investors recognize as unusual. And when the foundation of the financial system starts showing instability, capital begins searching for alternatives. That shift does not happen overnight. It begins quietly. First, a small group of investors starts hedging. Then, larger institutions adjust positions without drawing attention. Eventually, the broader market begins asking questions. By the time those questions are being asked publicly, the transition is already in motion. And this is exactly where silver becomes critical again, because silver sits at the intersection of two powerful forces. It is both a monetary asset and an industrial necessity. When financial systems weaken, monetary demand increases. When technological systems expand, industrial demand remains strong. Few assets operate in both worlds at the same time. Silver does. And because the market itself is relatively small, even modest capital flows can create disproportionate impact. This is why silver does not move gradually when conditions change. It reprices not slowly, not politely, decisively. If you hold 500 ounces of silver, you need to understand what that means now, because ownership is no longer passive. It is becoming strategic. And once that shift happens, the entire conversation changes. This is not about predicting a price. It is about recognizing a transition. You need to understand what is happening beneath the surface, because the shift we are discussing is not just about silver. It is about the structure of the system that assigns value to everything you own. Modern financial systems are built on credit. Governments issue debt to fund spending. Corporations borrow to expand and refinance. Consumers rely on credit to maintain purchasing power. For decades, this worked because borrowing costs remained low and liquidity remained abundant. The system expanded because it could. But no credit system expands forever. At some point, the scale of debt reaches a level where it requires constant support just to remain stable. And when interest rates begin to rise in that environment, pressure spreads quickly. Governments face rising interest expenses. Corporations confront tighter financing conditions. Consumers feel the impact through reduced access to credit and higher costs of living. This is not theory. This is the natural behavior of leveraged systems. And right now we are seeing those pressures emerge. Global debt levels have reached extraordinary heights. Deficits continue even during periods of economic expansion. Central banks are forced into a difficult position. They must control inflation while also preventing instability in the very system that depends on low borrowing costs. Those two objectives do not align easily. Tightening policy helps reduce inflation, but increases stress across debt markets. Loosening policy supports stability, but risks weakening currency purchasing power. This creates a tension that cannot be resolved cleanly. And when that tension builds, confidence begins to erode. Not all at once, not dramatically at first, but gradually. This is where most investors fail to recognize what is happening. They are trained to look for clear signals for definitive events, but structural changes do not arrive with certainty. They develop through small shifts in behavior that accumulate over time. Institutional investors begin adjusting allocations quietly. Hedge funds increase exposure to real assets. Central banks themselves expand holdings of precious metals. These actions do not create headlines immediately, but they change the direction of capital, and capital movement is what ultimately drives markets. Silver sits directly in the path of that movement. Unlike financial assets, silver does not depend on policy credibility. It does not rely on balance sheet expansion. It does not require trust in institutions to exist. Its value is tied to physical scarcity and real-world utility. That independence becomes increasingly important when confidence in the system begins to weaken. But silver is not only a monetary hedge. It is also deeply embedded in the modern industrial economy. This dual role is what makes it uniquely sensitive to the environment we are entering. Think about the infrastructure being built around you. Energy systems are transitioning toward electrification. Renewable energy expansion requires materials that can conduct electricity efficiently. Silver is one of the most effective conductors available. Solar panels depend on it. Electric vehicles require it. Data centers, sensors, telecommunications networks, and advanced medical systems all rely on silver in ways that cannot easily be replaced. This is not a temporary trend. It is a structural transformation of the global economy. Industrial demand for silver is not driven by speculation. It is driven by necessity. At the same time, supply remains constrained. Mining is not a flexible process. New supply cannot be created quickly. Discoveries take years to develop. Projects face regulatory hurdles, financing challenges, and operational risks. Environmental restrictions add further delays. And much of the world's silver production is tied to the mining of other metals. This means supply cannot respond rapidly. Even if prices increase, demand can rise quickly. Supply cannot. That imbalance creates tension inside the market. And when markets experience sustained imbalance, they eventually reprice to restore equilibrium. Not gradually, but forcefully. Now consider the scale difference between silver and the broader financial system. Global equity markets represent tens of trillions of dollars. Bond markets represent even more. Institutional investors control massive pools of capital that require allocation decisions. The silver market, by comparison, is extremely small. This creates a condition where even modest shifts in capital can have an outsized effect. It does not require a massive global consensus to move silver significantly. It requires only a change in attention from a relatively small portion of global capital, and attention is beginning to shift. This is why silver has a history of